All right, let's talk about India's direct tax system. At its very heart, there's one piece of legislation that rules them all, the Income Tax Act of 1961. In this explainer, we're going to unpack its core structure. We'll be zeroing in on the concepts and, the specific sections that are absolutely crucial to nail for your exams.
So here's the game plan. First, we'll tackle the fundamentals. Who pays tax and what income is even on the table. Then, we'll get into how all that income is sorted into the 5 mandatory heads. We're going to do a real deep dive on salaries, house property, and business income. And to wrap it all up, we'll see how everything gets pulled together for the final tax calculation. Ready? Let's get started.
Okay, so our journey into the tax maze starts with the most basic question you can ask. Who exactly has to deal with the Income Tax Act? And to get that right, we need to nail down 2 really important definitions right at the beginning. You'll find them both in Section 2 of the Act.
Okay, this is a super important distinction to get. On one side, we have the term person, which comes from Section 2, subsection 31. Now, this is a really wide net. It's not just about individuals, people like you and me. It also includes things like Hindu undivided families, or HUFs, which are a unique family-based entity in India, plus companies, firms, you name it. Basically, a person is anyone or anything that can earn an income. But, and this is the key, just because you're a person doesn't mean you automatically pay tax. That's where the other term, assessee, from Section 2, subsection 7, comes into play. An assessee is a person who is actually on the hook to pay tax. It can also be a deemed assessee, like a legal heir who has to pay tax for someone else. So the takeaway here is simple but critical. Every assessee is a person, but not every person is an assessee.
All right, so we figured out who can be taxed. The next logical question is, what income can India tax? And here's something really interesting. In India, it has nothing to do with your citizenship. It all boils down to your residential status during the financial year. And believe me, this one concept is what defines the entire scope of what you owe.
So the big question is, how do you get classified as a resident? Well, Section 6, subsection 1, gives us 2 basic conditions, and you only need to meet one of them. The first one's pretty simple. Were you in India for 182 days or more during that financial year? If the answer is yes, boom, you're a resident. If not, you move on to the second condition. This one's a 2-parter. Were you in India for at least 60 days in that year? And have you been in the country for a total of 365 days or more in the 4 years right before it? If you check either of these boxes, you're officially a resident for tax purposes.
But hang on, it doesn't stop there. Once you're a resident, there's another level we have to figure out. Are you ordinarily resident? Now for this, you have to satisfy both of the additional conditions from Section 6, subsection 6. Condition 1, you had to have been a resident in India for at least 2 out of the 10 years right before this one. And Condition 2, you had to have been physically in India for at least 730 days in the 7 years before this one. So let's recap that because it's super important. Meet one basic condition to be a resident. Then meet both additional conditions to become a resident and ordinarily resident, or ROR.
So what happens if you're a resident, but you don't meet both of those extra conditions? Well, that puts you into this middle category called resident but not ordinarily resident, or RNOR for short. This is for someone who meets one of the basic conditions to be a resident, but then fails one or maybe even both of those additional conditions. And this isn't just some legal jargon. As you're about to see, being an RNOR makes a huge difference to your tax bill, especially when we start talking about income earned outside of India.
And here it is. This table perfectly shows why we went through all that trouble. Look at that first row for Indian income. That's any money received or earned in India. See, it's taxable for everyone. Doesn't matter if you're ROR, RNOR, or a non-resident. That makes sense. But now check out the foreign income. If that income is from a business that's controlled from India, it's taxable for both ROR and RNOR, but a non-resident gets a pass. And then look at all other foreign income. Only the ROR pays tax on that. This table is basically the holy grail for understanding the tax on global income for individuals in India. You can bet you'll see questions on this in your exams.
Okay, so we've established who gets taxed and on what income. Now we need a system, right? A way to organize and calculate everything properly. Well, the Income Tax Act gives us a very clear, mandatory framework for this. It's in Section 14, and it splits all income into 5 distinct categories or heads.
And these are the only 5 buckets, period. Every single rupee that's taxable has to fit into one of these.
income from salaries, income from house property, PGBP, which stands for profits and gains of business or profession, capital gains, and then the catch-all category, income from other sources. And what's really important to get is that each of these heads has its own set of rules for how you calculate the income, what you can deduct, and even what might be exempt under Section 10. You can't mix and match. This structure is the absolute bedrock of your entire income tax return.
All right, let's kick off our deep dive with the first and probably the most common head of income from most people, salaries. Pretty straightforward. This covers any payment an employee gets from their employer.
The absolute core principle for taxing a salary is right here in Section 15, and you have to get this right. It says, salary is taxed on a due basis or a receipt basis, whichever happens earlier. So, what does that mean? Let's say your March salary is due on March 31st, but your company doesn't actually pay you until April. Well, it's still taxed in the financial year that ends in March because it was due first. On the flip side, if you get a salary advance, you're taxed in the year you receive the cash, not the year it was supposed to be for. The bottom line is, whichever event happens first, due or receipt, is when the tax clock starts ticking.
All right, let's tackle a classic exam favorite, house rent allowance or HRA. So you get an exemption for this under Section 1013A. But how much? Well, it's the lowest of 3 different amounts. The first is easy, the actual HRA you got from your boss. The second is the rent you paid minus 10% of your salary. And the third is 40% of your salary, or if you're in a big metro like Mumbai or Delhi, it's 50%. Now here's the trick that catches everyone out. For this HRA calculation, the word salary has a very specific meaning. It's not your total pay. It's just your basic salary, plus any dearness allowance that's part of your retirement benefits, plus any commission you get based on sales. If you mess up that definition of salary, the whole calculation goes wrong.
Next up, let's talk about retirement benefits like gratuity and pension. These have some very particular rules, and it all depends on who you work for, which is why they pop up in exams all the time. For government employees, it's pretty simple. Gratuity at retirement is totally tax-free. But for non-government employees, there's a cap, and the calculation is different depending on if you're covered by the Payment of Gratuity Act or not. It's kind of the same deal with pensions. Your monthly pension, always taxable. But if you take a lump sum or a commuted pension, it's completely exempt for government folks. For everyone else, how much is exempt depends on whether you also got gratuity. You really have to memorize these specific rules.
Okay, so after you've added up all your pay, allowances, and perks, and subtracted all those exemptions we talked about, you're left with your gross salary. From that, you get one final, very simple deduction under Section 16IA. It's a flat 50,000 rupees. Every salaried person gets it, no questions asked. It basically replaced a bunch of older, more complicated deductions for things like transport and medical bills. So it really simplifies things.
All right, moving on from salaries, let's get into 2 other huge heads of income. Income from house property and the big one, profits and gains of business or profession, which you'll almost always hear called PGBP.
So for any income to get taxed under the house property heading, Section 22 says 3 boxes must be ticked. 1, we're talking about a building or land connected to it. 2, you, the assessee, have to be the owner. And 3, this one's really important, you can't be using that property for your own business or profession. Why? Because if you were, any costs related to it would already be handled under your business income. So if all 3 of those are true, any income from that property is taxed right here. Now, this is a classic comparison question, self-occupied versus a rented out or let out property. For a house you live in yourself, the gross annual value is just assumed to be 0, nil. From that 0, the only thing you can deduct is the interest you've paid on your home loan. But for a property you've rented out, it's a whole different story. You have to calculate its gross annual value based on the rent. Then, from that, you get a flat 30% standard deduction for things like repairs, whether you spent the money or not. And on top of that, you can deduct the full interest on your loan. This difference is the absolute key to solving any problem under this head. Okay, on to PGBP. Section 28 tells us what counts as business income. And it's a lot more than just your basic profit. Of course, the revenue you make from your business or profession is in there, but it also includes things like compensation you get for a canceled contract or the value of any perk or benefit you get because of your business. It even includes the salary or interest a partner receives from their own firm. PGBP is really the big, comprehensive category for all gains from commercial activities. And the flip side is that this is also the head that lets you deduct the widest variety of expenses.
So we've gone through the individual heads and calculated the income for each one. Now it's time for the grand finale. This is where we pull everything together, take some final deductions, and get to the number that you actually pay tax on. This is where the journey ends.
This looks like a simple three-step process, but there's a hidden, super important step that's a big deal for exams. So, step 1 says you add up the income from all 5 heads. But wait, what if you have a loss in one head, like a business loss? Before you add everything up, you have to do something called set-off and carry-forward of losses. That means you first use that loss to cancel out profits from other heads in the same year. If there's still some loss left over, you carry it forward to use in future years. It's only after you've done all that set-off stuff that you get your gross total income, or GTI. From that GTI, you then take your Chapter VA deductions. That's things like Section 80C. What's left is your total income, and that's the magic number for calculating your tax.
So you've calculated your total income, and you've filed your return. You think you're done, right? Not necessarily. The tax department can then come in and do different kinds of assessments. Most of the time, it's just a summary assessment under Section 143(1), which is basically a computer checking for obvious mistakes. But you might get picked for a scrutiny assessment, which is a full-blown, detailed examination. If you haven't cooperated, they can do a best judgment assessment where the officer decides, and if they later find out some income was missed, they can open up a reassessment. So filing is just the beginning of the story.
And that pretty much wraps up our tour of India's direct tax regime. We've seen how incredibly detailed the whole structure is, right? From figuring out who a taxpayer even is, to sorting every rupee into its proper bucket, to finally calculating the tax. It makes you think, and this is the question I want to leave you with. Is all this complexity a good thing? Is it a feature that's necessary to make sure the system is fair and nobody can cheat it? Or is it a bug that just makes life difficult for regular people and businesses and is crying out for a simpler approach?